George of the jungle, strong as he can be.
All right, folks, let's face it. One of the ugliest words, one of the meanest things that you can tell a borrower is the phrase mortgage insurance. Sends shivers through their spine, causes them to fear and to sweat, and yet it's something that's really not that well understood. There are certain types of loans where, like it or not, you're stuck with it, and there's other types of loans where you might only have it temporarily, and being able to understand the difference might help you make a more educated decision on what type of loan that you should be qualifying for. That's what we're going to be discussing today in thecreditjungle.com. My name is George Anderson, and I have done this personally on my two different houses that I've owned. One of them that I owned prior to 1999, one of them after 1999. Why do I mention 1999? Because that was the year that the Homeowners Protection Act was passed, which codified the rules for being able to eliminate mortgage insurance. So the first thing you need to understand is that there are certain types of loans that you're not going to get rid of it. FHA and VA loans have a mortgage insurance element to them. They're a little bit different, but it's a lump sum on a VA loan. You have a funding fee if you're required to pay one. A veteran that is disabled, that has what's called a service-connected disability. In other words, if his disability is connected to his service in the armed forces, then he's exempt from the funding fee. And boy, I'll tell you, those are great, great loans. When you can do that, you want to go VA every single time. Never a reason not to. But veterans who don't have that stipulation are going to pay a funding fee, and that is a one-time fee that is added onto the loan, and it's just paid to the VA, and that's it. It's a lump sum fee. It's a sunk cost. It's paid. FHA also has a one-time lump sum sunk cost of 1 3/4% on all of their loans. That is paid. But FHA also has an additional monthly mortgage insurance premium. Anybody who's had an FHA loan since July of 2013 is going to be paying their monthly mortgage insurance for the life of the loan. The only way to stop paying that mortgage insurance is to pay off the FHA loan or refinance it and replace it with another type of loan, and that gets us into the conventional loan programs. So on a conventional loan, if you have less than 20% down, you're going to pay mortgage insurance. Now, a lot of people they cringe when they see this because they just don't see the benefit that it provides to them. Well, it's not intended to provide a benefit to you. It's a benefit to the bank. Just like if you have a loan on your car, the bank requires you to get comprehensive and collision coverage, not because they're trying to comprehendingly protect you from collision. What they're trying to do is trying to protect the asset which they have, which is not the car, it's the money that they've lent for you against the car. So it's the same thing there. So if you pay cash for your car, you don't have to carry comp and collision, you can only have liability. Same thing on a home. If you put down 20% or more, you're not required to carry the mortgage insurance. But anyway, the Homeowners Protection Act allows for that mortgage insurance to be canceled, and there's two different ways to go about it. The first thing that you need to know is that for the most part, most private mortgage insurance lenders will not allow you to cancel your mortgage insurance within the first 2 years if your basis for removing the mortgage insurance is that your balance on your loan has gone down a little bit and the value of the home has gone up a lot. If that gap that started out as being 5% down grows to where it's now 20% down, if that's happened within 24 months, you're not likely to get your mortgage insurance removed. I'm just telling you that that's just the way it is. But most people, though, it's going to take them a couple of years to be able to do that. Housing prices going up 5% per year, mortgage balance gets paid down 5%. You have the option to be able to have the bank consider that. And the way that you do it is to first you write a letter to them saying, hey, been in this house for 2 years, made some improvements, the market's gone up, I've been paying my mortgage payment on time, my loan balance is down, I'd like to provide an appraisal and show you that the value of my home, that my loan to value is at 80% or lower, and have you remove the mortgage insurance. Most banks are willing to consider that, but they're not going to let you pick the appraiser. They're going to give you an appraisal roster for people that are in your area, and they'll say, you know, just like Henry Ford, you can have any color car you want as long as it's black. Well, you can use any appraiser you want as long as he's on our list. But that list is going to have at least a half a dozen names on it, and then you pay for that appraisal, you submit it to the bank along with your written request, and they're going to look at that, and 9 times out of 10 they're going to drop your mortgage insurance. The other way to cancel your mortgage insurance, and you can avoid that 2-year rule, is by paying down the mortgage. Instead of having a 5% down, maybe 6 months later you have some windfall money that comes in and you put another 17% down and pay the mortgage down to 78% loan to value. You can do that, and the only thing you have to provide is that you are current on the loan, and that's it. And then they have to cancel the mortgage insurance on that. So some of the other caveats that might allow them to not cancel your mortgage insurance, even though you've been in the house for 2 years, even though the value of the house has gone up and your principal balance has gone down, if you have a home equity line of credit, they might look at that and say, there's an additional layer of risk here, and we think we want to have that mortgage insurance in place. That could be a real life scenario that you have to deal with. And the other thing is they could look at your payment history, and they're going to. And if you've been missing some payments, if you struggled a little bit, they might also look at you as being a potential default risk for that. So just be aware that you've got to have your ducks in a row. You've got to have a good payment history, probably not have any junior liens, judgments against the property, home equity line or something like that. But for a lot of people, that is actually a better solution than doing a refinance. Just recently I talked with a gentleman who called me. His interest rate on his house was 3.625. That's a great interest rate. Currently we've had better interest rates than that. And he was just wondering that, gosh, I know that I can't get that much better of a rate, but if I could get rid of this $200 a month mortgage insurance, it'd be worth it for me. Well, he was willing to refinance, but I asked him some questions and I said, well, wait a minute. So when did you buy the house? What do you think it's worth? His real estate agent provided a comparable market analysis, which is a really good estimate of what the appraisal value might be on there. And at the end of the day, I just told him, I said, look, it's not in your best interest to refinance. Number one, you've been paying on this loan for 5 years already. Okay, so you've already taken out the shallow part of the amortization curve where you're paying most of your money to interest. He's starting to pay and chunk down the principal balance faster, and he's only got 25 years left. Second thing is that the cost of the appraisal might only be $500. So he doesn't have to have his closing costs and the title insurance, requalifying, and everything else associated with it. For him, it was actually a better deal for him to just spend the $500, stay on his current amortization schedule, and get rid of his mortgage insurance that way. That is an option that every lender you sit down with should be making you aware of, that it's available, so that you can look at your own cost-benefit analysis on that and make your own decision on what works best for you. So again, to get Mortgage Professional, push the button, get my contact information. I would love to talk with you about your situation and give you some advice that is helpful for you. So thanks so much for coming into thecreditjungle.com. My name is George Anderson, and you have a great day.